Welcome back. This is our Investor Fact Sheet video 3 of our mini-series here, and let's get started where we left off. So now we're over on this area, and that's my name, Jim Hickey, with my MBA in Finance, Accounting, and International Business, my direct line, and our email. So if you are interested in learning more about investing, possibly participating in some investments, definitely give me a call, shoot me an email, and you can follow us on Instagram, Facebook, YouTube, Twitter, Pinterest. We have a ton of different social media and websites. Now what we do here is until we have an agreed upon contract with the seller, we don't post anything with the addresses or the pictures. All we do is we get letters of intent from our investors. Once we have reached our goal, then we can turn that into a cash offer instead of a financing offer, with the seller. But once the contract is accepted, then we do have the address and everything on there for you. Now here is some of the just basic details. So this is an equity investor, so $2.5 million. We are basically guaranteeing $50,000 a month cash flow for an annual amount of cash flow of $600,000. So that gives an annual return on investment of 24%. This present value interest rate that's used below, that was in video number 2. And on this particular deal, we're giving 80% equity for that $2.5 million. Here is some very, very important ratios, especially dealing with multifamily. So your debt coverage ratio, also known as the debt service cover ratio, or the DSCR, that being at a 1.8 is very good. So what a 1 means, that your income that is coming in is just enough to cover the debt. Most lenders will not go below a 1.2. Many require a 1.25. So this being at a 1.8 is a very, very good investment. It means that we have 83% above and beyond cash flow coming in to cover our debt. So an easy way of thinking of that is just imagine if your personal bills were, let's just say, $1,000 a month. Would you want to loan somebody money? So let's say your friend, his bills are $1,000 a month, and he only collects $1,000 a month. So that would be a 1.0 debt coverage ratio. So you wouldn't, no one would want to invest, give someone money for something like that. In this scenario, if this person, if their debts or their mortgage is $1,000 a month, they are collecting $1,830 in rents. So now you know that there's a lot of extra money there, in order to pay the debt. Capitalization rate. This is what is used, for your multi-family properties to kind of be able to compare them. Okay. So what we're doing with this is you take your net operating income and then you divide that by 10, or actually times it by 10, and that is going to give you a roundabout value of what the property is worth. So in this case, this is a 10.13 capitalization rate. So the property, they're estimating the property just to be worth the $1.75 million, same as the purchase price. Your gross rent multiplier. What this does is this takes into account all of your gross rents and basically computes it so you can calculate that versus different properties. So a 5.5 is very good. And your operating expense ratio. This, you want it to be under 50%, and all that means is that's taking your total rent and how much are the expenses in the rent. So in this case it's only 38.9. So when you collect the rent, 38.9 goes to pay all of those expenses that I talked about in video 1. I will go into very detailed videos on every single ratio, and everything. So don't worry, we will get to that. Um, Thank you again for tuning in, and remember, follow us on all our social media, and sign up for our email, and hopefully, we will do business together in the future. Have a great day.